In this video, we're going to discuss the beginnings of managerial accounting. So financial accounting has been around a very long time. I mean, we had an Italian monk that laid out the basics of financial accounting, which haven't changed all that much in the century since, in the 15th century. Okay, so that is how far back financial accounting goes. And we actually know that even before that book was written, that financial accounting and double entry bookkeeping and stuff existed. However, managerial accounting is much more recent, historically speaking. So we didn't get managerial accounting until the time of the Industrial Revolution. So we're talking about the 19th century here. Okay, so it's much more recent in terms of accounting. And what really gave birth to managerial accounting was the rise of factories. Large-scale factories had never been seen before, and they basically led to a demand for new types of accounting, and here's why. So let's take a factory, for example. Let's take a textile company. Let's say that they make wool clothing, okay? In the past, let's say we're talking about 1540, that year or something. If somebody wanted an article of clothing, there were several things that needed to be done. First, you needed to shear the wool, right? You need to actually get it off a sheep, but then you needed to clean it. There's a thing called spinning. Then there's a process called weaving, etc. You could even dye the wool potentially if you wanted a certain color. So there's these different processes, and each of these processes could have been handled by a certain artisan, right? So there's a certain person that handles each part of this, right? There's a certain person that handles each part. And what happened with factories is, for the first time, you're getting all these people are coming under one roof. They're all going to be working under the same roof, right? So you have all these people, these large-scale companies that did not exist before, okay? And now they're going to have machines that they're working on in this factory and so forth, right? So I cannot estimate enough or emphasize enough the importance of factories in the development of managerial accounting. And here is why. Here's why. So let's say that we have a piece of cloth or a piece of wool here, okay? And then we have, let's say this is 1 square foot. 1 square foot that we have of wool. And the question is, what did it cost to produce this? What is the cost of producing 1 square foot or 10 square feet or 50 square feet or so forth, right? What does it cost? We can't just say, well, what did we pay this person? What did we pay this person? What did we pay this person? We can't just add it up because we're not farming it out to these different people. What we instead have now with the factory system, we have all these people are under the same roof. And now they're not independent artisans, they're laborers. Okay, they're laborers who are given an hourly wage, okay, or a daily wage. So we've got all these people, they've been collected under one roof, and now they're given this wage. And so now it's more difficult to figure out what is the cost of producing 1 square foot of fabric. And why do we care about the cost to begin with? Because we need to be able to set the price. We don't want to set the price below the cost, right? Otherwise we'd be losing money. And so we needed to figure out with the rise of factories, what was the cost per unit? And so that is one of the fundamental things of managerial accounting. And still, if you take a managerial accounting class today, you're going to be talking about a variety of different ways to calculate the cost per unit of producing something, right? Now, that follows from that, when you figure, okay, well, what is the cost per unit of producing fabric? We'll also say, okay, well, now that we know the cost per unit, we can actually use that to figure the value that we're going to assign to the company's inventory for the balance sheet. And this technically gets a little bit into financial accounting, because if you know manufacturing companies, one of the things of managerial accounting generally doesn't follow GAAP and so forth, but one of the things that actually is related to financial accounting is financial accounting. You produce a balance sheet and so forth for investors and creditors, and manufacturers need to know, hey, what is the value we're going to assign to the inventory? You might say, well, let's just use the fair market value. Let's just say whatever the fair market value of the inventory is, so we don't need to worry about the cost. But that's not how it's done. It's not done, right? So we don't value the inventory at its fair market value. Generally, we value it at its cost. Okay, there are exceptions to that and so forth. I don't want to get into all that, but the basic idea is generally inventory is on the balance sheet at its cost. And so then the question is, if it's a manufacturer, well, what is the cost, right? If it's a retailer, it's a little bit easier to figure out what is the cost. But for a manufacturer, because they're actually building the inventory, we need to figure out, well, how do we assign this value? Okay, so that also, and then leading from that, so we need to figure out, well, what is like the ending inventory for the balance sheet? But then also, what follows from that, we can figure the cost of goods sold. Okay, COGS, cost of goods sold, which is going to go on the income statement. Okay, so we can figure these things out once we can figure out the cost per unit. But that wasn't the only thing that happened during this time frame that led to managerial accounting, because managerial accounting is more than just the cost per unit and cost of goods sold and inventory and so forth. We had the rise of railroads, and railroads were the largest companies ever at that time. Like at that point in time, they were massive. There had never been companies that large, right? They were even larger than the factories. And so they had where they would span an entire country, right? When you think about the United States and so forth, right? This railroad going across the entire country. And so what happened is these companies were so large that they were split into multiple divisions, right? This could be based on geographic region of the country and so forth. And the managers and the higher ups of the companies needed to find a way to evaluate these large divisions. And if you know a little bit about managerial accounting, that is a big part of managerial accounting, is we look at segment reporting and breaking the company up into specific parts, right? We break the company, we slice it into specific parts and evaluate each part, right? Financial accounting, we're looking at the consolidated entire picture of the entire firm, right, with the financial statements. But managerial accounting, we're breaking the firm into the chunks, right, into divisions, and we can look at the profitability of each division. There's these things called cost centers, there's revenue center, investment center. We'll talk about all that in the videos to come, but that's the main idea. Also, railroad companies developed a lot of very useful metrics, right? Things that weren't GAAP, but were just useful to help make better decisions for the managers, right? And that's the main idea behind managerial accounting, is we're trying to make better decisions, okay? We're trying to produce information that's not necessarily GAAP, but will help managers make better decisions. And so one thing, for example, with the railroads that came up with is this thing called cost per ton mile. Okay, and so a lot of these metrics that they came up with, some of them are even still in use today, like cost per ton mile, for example. And then final point is also these railroad companies, as they had these large divisions, they had to set up these things called transfer prices, which if you don't know what that is, we'll talk about it in a future video. But they had to set up transfer prices to coordinate activities between the divisions, right? Basically, a transfer price is the price when we got Division 1 in the company is selling something to Division 2. The question is what price should be charged, should there be a price chart, and so forth, to coordinate the activities between these rather large companies. How do we coordinate the activities between them so that we're looking out for the best interest of the entire company? All of this stuff began with the Industrial Revolution.